If you have a business or you work in business and you want to better understand financials, but you don't really have a firm grasp on them quite yet, no worries at all. Unfortunately, it's not really something that's prioritized in schools, how to read financial information, how to understand financials. And so what I'll be going through in this video is how the income statement is laid out, how the balance sheet is laid out, what information is on each of these statements, and what we can learn from these statements for our business. So let's dive in. Okay, so welcome to Understanding Your Financials. So what we'll be doing here is looking at how to understand and navigate financial statements. So a bit of an overview here of what we'll be doing. We'll be looking at an introduction to financial statements. What are they? Do a bit of an overview of financial statements. Then we'll talk about connecting the dots. We'll dive a little bit into debits and credits. You've probably heard these terms before. It's not scary. We'll try to simplify it for you and try to make it pretty understandable. Then we'll look at how transactions impact the financial statements, and then we'll do a bit of a recap at the end there. We'll try to keep it quick, try to keep it snappy, but try to help you have a good sense of financial statements at the end of this. So first of all, what are financial statements? If you go hop on Wikipedia, currently the definition is formal records of the financial activities and position of a business person or other entity. Or you could just say it's kind of like a snapshot of your business's money story. Okay, so that's what financial statements are. They're typically comprised of three different statements. So when you hear financial statements, usually there's three different statements, but the two that we're going to focus on today are the income statement and the balance sheet. Okay, but usually you've got an income statement, balance sheet, and a cash flow statement. Okay, but again, in the video here, we'll be looking at primarily the income statement and the balance sheet. All right, so the income statement is typically referred to as the profit and loss statement. You've probably heard that, or the P&L. The purpose of the income statement is to show your revenue, your cost of sales, and your overhead expenses, and essentially your net income. Okay, so we'll just kind of like go through the anatomy of the income statement here so you can get a sense of how it's laid out. Typically, when you look at your income statement, the first thing you're going to see is the heading at the top will show the company name. It'll say statement of income or income statement, however they end up wording it. And then lastly, you'll see year ended, say December 31, 2023, or whatever period it's for. That date will indicate the period that this income statement is relevant to. Okay, so if you're looking at annual financial statements, then typically it's going to say year ended and then the fiscal year end. Okay, so if your fiscal year end is December 31st, then it'll be the December 31st date. If your fiscal year end is a different date, then it'll be a different date. Okay, but that's usually what you'll see at the top here. Then you start with revenue. Okay, so revenue is the top line of your income statement, and that's why oftentimes you'll hear it referred to as top line revenue. Okay, that's what revenue is. Then you have your cost of goods sold. Costs of goods sold are your expenses or the costs that you have to deliver your sales. Okay, so if you sell shoes, for example, then your cost of goods sold will be the shoes that you purchase, your inventory, once it's sold, right? That will be the cost. So if you say it costs you $30 to buy a pair of shoes and you sell them for $100, right? When you make a sale, your revenue will be $100. Your cost of goods sold on that sale will be $30, right? So then the next line here would be your gross profit. So on that, you'd have $70 of gross profit. Okay, so the gross profit is the difference between your revenue, okay, and your cost of goods sold. You've probably heard the term gross margin. We'll cover that in a different video when we look at specific metrics and analyzing financials. But gross margin is essentially if you take your gross profit and divide it by your revenue. It's based on a percentage base. So you can look at your profitability on your sales on a percentage base of revenue. All right. The next section of your income statement is going to be expenses. And so these expenses are typically your overhead expenses, general and administrative overhead expenses you've probably heard, or selling general and administrative overhead expenses. You might have heard those terms, G&A, SG&A. Those are your overhead expenses that are required to run your business. Okay, so everything up here, revenue, cost of goods sold, and your gross profit, Those are what you do when you run when you operate your business and do sales. You have revenue coming in, you have up here, you have costs that are related to your sales, and then you have your gross profit. However, you have a business that needs to run in order to support your sales activity, and so that's what your overhead expenses are. Okay, so you'll have advertising expenses. Amortization and depreciation has to do with your long-term assets. Okay, you expense them over time. Business taxes, licenses, and memberships, right? Different things like that. Interest and bank charges, insurance, etc., etc. You can kind of see the types of overhead expenses. Salaries and wages is an interesting one because typically, generally speaking, and not everybody does this on a consistent basis, so you sort of have to look into it depending on the company. The salaries and wages, ideally you want to try to put any salaries and wages that are directly tied to the delivery of your services or products into your cost of goods sold, okay? Because they are directly tied to the delivery of your sales, of your services and your products, and so they should be in there to really best understand your gross profitability. And then any salaries and wages having to do with just running the company in general, administrative, management, etc., can fall into here. Now, not everybody does that. It's not the end of the world if you don't, but it's just good to be aware of where those might be sitting in the income statement that you might be looking at, because that does tell a story. Okay, then we have other income. So other income, that could be investment income that a company might have, or sort of ancillary income, not necessarily related to the core services or products that the business is selling, but other income that's coming in. So that usually falls down below here. And then we have the income before taxes amount, and then we have our income taxes, right? So you're going to have corporate taxes or business taxes that are relevant to the company, which also reduce net income. And then the bottom line here is called net income. That's where the term bottom line comes from, right? Bottom line income. What's the bottom line? It's because net income is on the bottom line of your income statement. Okay, so net income is essentially how much money the company made at the end of the period that we're looking at, typically like a year, for example. How much profit after selling all the goods and services, paying for the delivery of those goods and services, paying for all the operating expenses of the company to keep the company going, having any kind of other income coming in, and then paying all the taxes. What is the net income at the end of the day? All right, so essentially from this you can understand and view your profitability. All right, so the next statement that we'll be looking at is called the balance sheet, okay? Other terms for this, you may have heard the term statement of financial position, and that's because the statement essentially tells you the financial position of a company. So the purpose of it is to show the financial position of a business, and it's at a specific point in time, okay? So again, and we'll look at that shortly here, but essentially it breaks it down into assets and liabilities and equity. Just for some terminology here, assets are what you own and liabilities are what you owe, okay? And then equity is sort of your value in the company, and so we'll look at that shortly here. So looking at the anatomy of a balance sheet, again, similar to the income statement as we saw, you're going to have your company name up top, the name of the financial statement, so here is balance sheet, and then you'll have the date that it's relevant to. So this is going to be a snapshot at a particular point in time. And so quite often when you're looking at financial statements, you will notice that the amounts that you're looking at on them won't necessarily be current at the time you're looking at them, right? Because they're specific as of a point in time. Sometimes when you hear people talk with respect to balance sheets, you'll hear people speak like, cash was $200,000 as at December 31, 2023. Okay, that means basically as of is just, we like to speak differently, I suppose, as accountants, but basically as of that date, right? As of the date on the balance sheet, this is what these numbers are as of that date. Okay, so broken down into assets, liabilities, and equity. So again, assets are what you own, liabilities what you owe. So first part, the top part is assets, and so within assets there, the first section is called current. Okay, you'll see this in the balance sheet. Current essentially means anything that is essentially liquid or can become cash within the upcoming year. Okay, so obviously cash would be, accounts receivable is going to be any of your invoices, right? So if you have a sale and you issue invoices, that is a receivable. So those are your accounts receivable. So theoretically, hopefully, right, you will be collecting on your accounts receivable within the year. Work in progress case, this is going to be costs that you've incurred for projects that you're working on. This is pretty common in construction that you still need to bill for, right? It's almost like inventory. And then prepaid expenses, this could be deposits that you've made or insurance. So they're basically cash outflows in some of these cases that will be expensed within the year, or some of these things become liquid within the year. So everything is sort of like within the upcoming year when it comes to current assets. Again, things that you own. Okay. Next is property, plant, and equipment. Some people also refer to this as capital assets. They are the long-term assets in your company. And so if you have a company with machinery, then the machinery will be parked in these accounts, typically in specific accounts that are summarized into this line of the balance sheet. But these are assets that you own, and then they are depreciated over time. So we saw the amortization expense line on the income statement, and that is essentially the gradual expensing of capital assets over time. So that's what property, plant, and equipment is. And then total assets is essentially summed up at the bottom here. Next, we have liabilities and shareholder equity. Okay, so then very similar to what we saw with assets, you have current and long-term. So the current liabilities are going to be any liabilities that you have. So again, liabilities, what you owe. So current liabilities are going to be any liabilities that you have that are coming due within the upcoming year. Okay, again, typically current has to do with the upcoming year. So accounts payable, these are going to be invoices that the company has that they have to pay. Usually, right, if you want to maintain good relationships with your vendors and your suppliers, you want to pay those on time. So those should be paid in the upcoming year. Taxes payable, usually those are due within the year. If you want to avoid problems with your tax authorities, then you should be paying those within the year. And then another example here is current portion of long-term debt. So typically when you have long-term debt, a loan or whatever it might be, in the upcoming year there are principal payment requirements, and so you kind of take that portion out of your long-term debt, put it into a current portion of long-term debt, which is in your current liabilities section here. Then our next section is going to be long-term debt. Okay, so this is going to be long-term liabilities. So maybe the business has a loan, for example, that may fall under that. Other things that might fall under there also may include capital leases, right? If you have capital lease obligations on machinery or equipment or vehicles, that would also fall under in this section under long-term liabilities. And so then all your total liabilities are tallied up down here. Okay, so you have $475,000 there between the 225 and the 250. And then we get to shareholder equity. So shareholder equity represents the value of the shares that have been issued by the company to shareholders, as well as the accumulated earnings of the company over time. Okay, so you've got share capital and you have retained earnings. So again, share capital represents the value of the shares. So you could have common shares, you can have preferred shares. Those are shares that are issued by the company that shareholders purchase, and so that number there represents total value of what that amount is. And then retained earnings is the accumulated net income over time in the company. Now you might have a deficit there, right? Maybe it'll be a negative number. That's going to be a deficit. That would be from accumulated losses over time. Okay, so that gives you your total equity. And then when you look at that, the total liabilities and equity should equal the total assets. And that's why they call this a balance sheet, is because it should balance. Okay, at the end of the day, it should balance. And this kind of also has to do with double entry accounting, where everything needs to be in balance because you have two components of every transaction that need to operate or be entered in balance to each other, and we will be looking at that next. Okay, so now that we've gone through the income statement and the balance sheet, and you have a better idea of what's on each of those financial statements and what they mean, what the information on those statements means, then let's hop into this section here, connecting the dots. So the first thing we'll do, I'm just going to move my little video out of the way there so we're not in the way here. So again, connecting the dots. So we've looked at the income statement again. This kind of looks at how well a business is performing over time from a profitability perspective. And then you have your balance sheet, which is, again, your financial position at a specific point. So how do those two statements interrelate with each other, right? Because they're typically provided along with each other and oftentimes with a cash flow statement. But how do these two relate to each other? Well, one way they do is the net income from your income statement feeds into the retained earnings balance. So if you recall from as we were looking at the balance sheet, I mentioned your retained earnings amount represents the accumulated profit or loss over the years in the company. And so your net income should be within that amount, okay? So retained earnings here, we're showing $1,204,900. So within that, we have $355,110 from the current period, okay, for the year ended December 31, 2023. But more so, we're gonna look at what happens when you enter a transaction into your system, okay? So two things happen. You have a debit and you have a credit. And this is where I say, like, buckle up. We're gonna get a little bit accountancy here, but not too bad, okay? We'll try to keep this fairly accessible. I want you to just kind of understand the basics on this. So I won't get too crazy here, but there will be some accountant speak happening. But after watching this, hopefully you'll be able to better understand what these terms mean. So you have debits and you have credits, okay? Now a debit, in simplest terms, increases what you own, it decreases what you owe, it decreases what you earn as far as profitability goes, and then credits decrease what you own, they increase what you owe, and then they increase what you earn. And that typically, if you have revenue, it's going to be a credit, and if you have some kind of refund on an expense, it'll also be a credit, so it'll increase what you earn in terms of net income. Okay, so if you kind of remember those bullet points for both of these terms, it should help you in sort of understanding these concepts. So let's kind of dive into that a little bit more. This is called double entry accounting, so you may have heard that term before. And basically the debit and the credit impacts either the income statement or the balance sheet in each transaction, okay? And so we'll see what that looks like here sort of with some examples, all right? So let's take the example of recording revenue and accounts receivable. So you make a sale, right? And then your company records revenue and accounts receivable. The revenue is your income, right? Your top line revenue. The accounts receivable is the invoice that's payable to you, right, by your customer, your client. And so it's an account receivable. So when you do that transaction, you're going to have a debit and a credit. So what happens here? Well, the debit will be the increase in the accounts receivable, because again, you are now increasing what you own. What you own is a receivable. You have a receivable that is owned by you, right? And so it's payable to you by your customer or your client. And so you debit your accounts receivable, that's on your balance sheet. And then you credit your revenue, okay? So you're gonna have an increase in revenue, you're gonna credit your income statement for that. So again, remember, credits will increase what you earn, right? So if you're going to earn revenue, you're going to credit your revenue, all right? So what does that look like from a financial statement perspective here? On the financial statements, we're going to credit our revenue, okay? So top line revenue is going to be a credit to that. And then on the balance sheet, we are going to debit our accounts receivable. There's always going to be a credit. There's always going to be a debit. They're for the same amount of money. And so that balances things, okay? Next example, let's say you're receiving payment for your invoice. So you've made the sale, you have the invoice, but now you get paid for the invoice. What happens there? Well, first thing that happens is you have an increase to your cash balance, right? So you got paid, so you've received cash in your company, and so that will increase what you own. Cash is something that the company owns. You will increase that, so that's going to be a debit to your cash, okay? And then on the credit side, what credit happens in that particular transaction? Well, you're going to decrease your accounts receivable, right? Because you no longer have that receivable, it's been paid. And so you will decrease that amount. So if you decrease what you own, because you also own that receivable, you want to decrease it. So that will be a credit to decrease your accounts receivable. All right, what does that look like on your financial statements? Because again, you're going to have a debit. Sorry, I just hit my mic there. You're going to have a debit, you're going to have a credit. Both of those things happen on your financial statements. They have to be in balance, right? And so you're going to debit your cash, and then you're going to credit your accounts receivable. Okay, so that's what that transaction would look like. Let's say you're recording a vendor invoice. Okay, so you get an invoice, using a shoe example, maybe as an example, right? So you have sold some shoes, and one of your shoe suppliers sends you an invoice. You need to record that invoice, right? What happens when you have an invoice? You have an expense, which is going to decrease what you earn, and you're also going to have something that you owe. And an invoice is something that you owe. So you're going to increase something that you owe, right? So if we're going to decrease what we earn, that's going to be a debit. And so you're going to debit something on your income statement. It will be some kind of expense, right? So it might be your cost of goods sold. So maybe it might not be cost of goods sold. Maybe what the invoice for is insurance. Maybe you got an invoice from your insurance. And so that's what that invoice is for. So you're going to increase your insurance expense. That will decrease what you earn. So that's a debit on your income statement. And then you're going to increase what you owe because there's accounts payable there. And so you need to have a credit on your balance sheet for your accounts payable. Okay, so what does that look like on our financial statements here? And realize my little video head is in the way there. All right. So on your income statement, you're going to have a debit to your cost of goods sold. Again, right? That's assuming that you what the invoice for was for things that you were selling. If it's for overhead type expenses, then it'll be one of these accounts down below in expenses there, your overhead. And then the credit will be to your accounts payable on your balance sheet. So again, you're decreasing what you earn, right? So a debit to your income statement will decrease what you earn as far as decreasing your net income. And then a credit to your balance sheet will increase what you owe. All right. All right. Last example is, we'll just throw me over there again. All right. So recording a new loan payable. All right. So say a company needs some additional cash, needs some financing, takes on a loan. And so what happens when you have a loan? Well, you're going to increase your cash. Do you own that cash? Yes, you own that cash, right? So you're going to increase what you own, which is going to be a debit, okay? And then you're going to also increase what you owe because now you have a loan. So you increase what you owe, that will be a credit, okay? And so what is that? And that's also on the balance sheet. What does that look like here? That would be a debit to cash, right? Because you're increasing what you own, you're increasing your cash balance. It's going to be a debit to cash, and then you're increasing what you owe as well. And so that's going to be, say, a credit to your long-term debt. All right. Okay. So let's just do a bit of a recap there. I know it was like kind of a speed version of financial statements, but let's just do a bit of a recap. Hopefully this will help. So again, financial statements are formal records of the financial activities and position of a business, person, or other entity, okay, as described by Wikipedia, as at this date, to use accounting speak there. Or, in simplistic terms, it's kind of like a snapshot of your business's money story. Then we looked at the interrelation here between your income statement and your balance sheet. So again, your net income feeds into the retained earnings of your income statement. Again, retained earnings represents your accumulated profits or losses within the company over multiple periods of reporting. And again, your income statement is how well a business is performing over time, over a particular period from a profitability perspective. And then your income statement is your financial position as of a specific point in time, okay? All right. Then we had examples. So we looked through specific examples of recording revenue and accounts receivable, receiving payment for your invoice, right, for your receivables, recording a vendor invoice, and then recording a new loan payable, okay? What happens in each of those situations? Again, the question you should be always asking yourself when you're wondering the impact that it will have to your financials is, am I increasing what I own, right? Am I increasing what I owe? Am I increasing what I earn? Am I decreasing what I earn? Okay, some of these questions you should be asking in terms of how those impact the financials. Again, you will have a debit and you will have a credit for every transaction in your books. And so those will impact your financial statements in different ways. And so that's what we looked at as well, right? As each transaction will impact the income statement or the balance sheet, or maybe just the income statement, or maybe just the balance sheet. And so it's important to just recognize how that might happen. All right, in summary, the numbers tell the story, and that story is told on the form of your financial statements. And in particular, we looked at your income statement and we looked at your balance sheet there. I hope that was helpful. I know it's kind of a speed drive into financial statements, a pretty quick overview, but hopefully from this you've been able to get a better understanding of what you're looking at when you're looking at the income statement, when you're looking at the balance sheet. Hopefully you can now better understand where to find things in your financial statements, and also have a better understanding or idea of how specific transactions may impact your income statement or your balance sheet. If you have any questions about any of these topics or anything that we've covered in this video here, check out the links below and feel free to reach out. Thank you.